In this video, you will learn everything that you need to know about trading liquidity. Now, you've probably watched videos in the past, but are still left wondering what liquidity even is. Not only will you learn what liquidity is in this video, but you will also learn how to adopt this to your own system, along with some trade recaps of trades that I've recently taken towards the end. But my goal here is to keep it to its simplest format without overcomplicating it. Now, you probably don't know, but liquidity actually drives the market. It is generated and targeted by market forces, and a lack of understanding in this area is often why many traders fail, even if their analysis is correct. Now, a common scenario where this becomes evident is when traders get stopped out by a sudden price spike, which can also be viewed on the technical chart as a wick, before the price moves in your favour and hitting your take profit. Now, this has most likely happened to you, but this also highlights the difference between having strong analytical skills and strong trading skills. Unlike order blocks and imbalances and other points of interest, liquidity cannot be seen directly on a technical chart. It is invisible, but can still be identified through price action alone and the knowledge you're about to learn, without the need for indicators. In essence, liquidity represents money in the market, typically from retail orders and stop losses. So recognizing that the market targets liquidity and that this liquidity often comes from retail stop losses reveals that the market often moves against common retail systems. Now, one of the most common retail systems out there is trading based on support and resistance. Now, before I jump into this, I'm not here to, necessarily blow or, gas my own way of trading or try and shit on other systems. That's not where I'm getting at. You can be profitable if you trade support and resistance, trend lines, the way I trade, the way ICT trades, the way SMC trades, whatever the way you're trading, it does not matter, because it can be made profitable with the right and necessary refinements. So, for example, going back to what I just said, retail traders might identify a resistance level and look to sell or short from this point, anticipating a potential price drop. This behavior creates a liquidity pool just above the resistance level where many traders place their stop losses. Now, this liquidity pool then becomes a target for the market. Instead of trading the anticipated move down, experienced traders wait for the liquidity grab before leveraging their system to profit from the subsequent bearish move. Now, moving on, the forex market is a zero-sum game, which means that for a trader to buy or sell one currency pair, it is necessary that there is another trader with an opposite position. If smart money, which is also referred to as the banks, want to buy a currency pair, they will need sellers in the market, and vice versa. If they want to sell a currency pair, they will need buyers in the market. The existing facility to place these positions in the market is called liquidity. The liquidity is defined and referred to as stop losses. Plain and simple, stop losses. Where the stop losses exist is where the liquidity also exists. Again, going back to an example, you probably entered a buy or sell position before, it's hit your stop loss and gone on to hit your TP. Your bias is not wrong, your stop loss placement is just wrong, and potentially a lack of understanding of liquidity. But smart money or banks need to activate the stop losses of existing orders and existing positions in the market so that they can place their positions in the market too. Now we have that in mind, one practice I like to apply when thinking about liquidity is to think about where the majority of traders would be entering the markets. So, for example, look at support and resistance, double tops, double bottoms, trend lines, key levels, whatever the reason, whatever the system. These are common approaches to the market, and obviously every new trader that comes into the market will most likely learn about support and resistance, especially if they undergo something like baby pips. So again, because these are common approaches, and having the info in mind that we're about to discuss and have been discussing so far, will allow us to look for entries around this. So when it comes to liquidity, there are advanced types of liquidity in the market. Again, liquidity is just stop losses, When it comes to advanced types of liquidity, liquidity is literally everywhere, under every high, under every low in the market. Now, we don't need to focus on every high or low in the market, we simply just need to wait for a liquidity sweep, then ideally a shift in anticipated direction, and then we look to react and look to trade, rather than trying to predict which liquidity is going to be swept. Because there are two important rules when it comes to trading liquidity, so get ready to write this down. And number one is that pending liquidity should be used as targets, not a bias. And number two, liquidity sweeps can, however, influence your bias. In other words, wait for the sweep of liquidity first before entering. So moral of the story is that you will never know when liquidity will be taken 100% of the time, but you can react based on the liquidity being swept. Now that we're on the chart, just to quickly recap, liquidity mainly refers to stop losses, but it's not just obviously stop losses, it's also the orders that are being entered in the markets. So for example, you've got many traders looking to short off this area, looking to short off this area, and they're most likely going to have to stop loss above these highs within the market. Now I've done many videos on why this block here is one of my main key, ways of trading liquidity. It's known as the Asia Run. So if you want to learn about that, just scroll down to my YouTube videos and you'll just see a title: Asia Run, Asia Session, Asia Trading, whatever it is. Look for that and you'll learn why. Obviously, if you want to learn a bit more advanced and actually how to enter, where to target, where to get out, etc., then sure, join my mentorship and live calls and you'll learn exactly my system. But with that being said, 12 to 5 AM UK time is my Asia Run. Again, I won't get into the reasons why. I'll discuss that in all the other videos, but that is a very key liquidity point in the market. With that being said, as you can see here, again, like I said, if some of the terminology, for example, like supply, demand chain, etc., who's in control, if you don't understand all that, I'd highly suggest joining my mentorship. But with that being said, as you can see here, we have a 15-minute POI all the way up here and a 15-minute POI all the way up here, which is also part of a previous chain. Now, when you look at price sweeping out this liquidity area here, price initially swept out these highs here and also moved bearish. Okay, now obviously when the prices moved bearish, we didn't really take out a major structure, although we did here, but we took out some minor structure as well. And obviously minor structure, you have sellers here, you'll be having potential breakout sellers here as well, anticipating a potential reversal that are following this way. Okay, and obviously again, this hasn't really tapped into any high time frame point of interest. And when it comes to trading the markets in general, it's all about volume and location and timing, really, because timing in the markets is really important. This here, 5:30 in the morning, isn't really inside of my key trading times or my kill zones, essentially. Okay, this however is. So again, as you can see here, price took out over all these lows, so you have plenty of sellers selling within this market, anywhere from here to here, and even potentially within this move here. Now, whether the stop losses be, it's most likely going to be at these highs or the major highs there. Okay, like I said, liquidity again just more so refers to stop losses. That's a big contribution to liquidity, but also the positions being placed in the market. Orders and stop losses, entry and stop losses more specifically, is your liquidity. Okay, don't get me wrong, there are other terms of like trading liquidity, for example, how easy it is to to buy or sell a certain asset, but I'm on about liquidity trading in the sense that the way that I've discussed so far. Okay, anyways, as you can see here, price came back up, tapped into the high time frame point of interest, also sweeping out previous liquidity and the Asia highs. And all I was simply looking to do here was trading the potential pullback on the M15 into this POI, hence where was my target. Alright, as you can see here, price initially shifted bearish here, but didn't pull back into any point of interest. Now, when it comes to the market in general, I'll just give you guys a quick tip. Even though, yes, initially I shifted bearish, so you can potentially anticipate a bearish market, although it is a shift, and the first shift or the first break of structure in the opposite direction is usually unconfirmed trend. Okay, so obviously it's better to see a break of structure, like for example here, or here. But anyways, what I was about to say is that even though, yes, price has shifted bearish, also when you look at who's in control, demand is still in control. So it's better to have a shift that aligns with demand being taken and supply potentially stepping in. Anyways, as you can see here, price also took out these lows here and also violated this demand. And obviously when you look at it like this is a demand zone, but we can now refer to it as a supply, because again, we can extend that zone to the right and trade from that same point of interest. Now this is better suited to market conditions like this, where price is rallying heavily within a shorter period of time in one direction. You see breakers being respected than, for example, price pulling back to the extremes in market conditions like that. I've gone a little bit off topic, but there's just little gems for you guys that you can write down and study. Anyways, as you can see here, price closed below this low here, pulled back with this wick, filling some partial imbalance there, and also again you can argue that there's a potential breaker there too. I just refined it to the low there. There's certain rules why, but again, join my mentorship to find out why. As you can see here, all I waited for was price to tap into this area, which I initially did here, and then used my candle confirmation, way that we trade our confirmation, to enter the market. Now I finally got an entry here. This is obviously because it's a manual execution. I got filled in at a slightly lower price than what I anticipated, simply because of the broker spreads. Okay, I'm trading Mass Trader at the minute. This is where I got filled in at that exact price. Stop loss was just simply above the high and targeting 10-15 POI. But the reason I shorted from there is because we also swept out that liquidity and shifted bearish. Okay, now don't get me wrong, when it comes to what I was saying earlier in terms of reacting, not predicting, this is a great example of that. So even though that we have swept out the liquidity to the upside, we can anticipate a potential sell off, you know, a bearishness push in the market. It is important to not trade that directly until you get that shift in market structure. So for example, price was previously creating higher highs, higher lows, etc., but the high low got taken, and obviously demand got taken too, so the two confluences are there for price to potentially reverse. Now obviously if I was trading based on just, you know, liquidity being swept and no shift, etc., then I'll just simply be looking to sell, for example, based around here, or, you know, selling around here, and you would have just been stopped out. Now obviously it's a little bit more advanced, and like I said, join the mentorship to find out why I traded here, not there, even though I've already briefly discussed it. Well, that's just one example, and I'll be going into a couple more examples just to really show you, and just so you can understand it a little bit better. And also just a super quick little idea here for you guys to think about is that even though yes I'm in shorts, you can also target into liquidity. Now I targeted here for a specific reason, but if you just take a look here, you can clearly see that there's a big support zone. If you just ignore this bit of price action to the right, you can clearly see there's a big support zone there, so there's going to be many buyers looking to long off that area, therefore having a stop loss just below these areas here. Now again, like I said earlier, you're not going to be able to technically or physically see on a technical chart where the liquidity is, but you can more so anticipate where it's likely to be. Now again, you're not going to be right 100% of the time, because nothing in trading is 100%. You must remove that ideology of everything being 100% in trading, because it's not. All that we have to be is right, like not even more of the time, but right a bit of the time and capitalize on it when we are right. And when we're wrong, get over it, move on to the next one. Okay, but that's just something to think about in terms of targeting through liquidity, so you can actually target into those lows, hence why price took out those lows and started to more so consolidate. Okay, here is another example. Now I don't really have a lot of markings in terms of like the trend line mark there for my shift and so on, just simply because I can see it. It's become second nature, similar to, for example, when you're learning how to drive. At first it's difficult, you get the gears messed up, you don't understand it well, but then after a while of driving, it just becomes second nature. You know exactly what gear to go and when, because it's just based on how the car feels, etc. Okay, that's a similar reason to trading. Once you learn to train your eyes, you'll sort of have a similar outlook to what I just mentioned in terms of just seeing what you can see on the charts and trading based on what you can see. That's just why I don't have a lot of markups on my chart, because to be honest, if I draw up every single trend line and POIs, etc., it just becomes confusing, and therefore you begin to overcomplicate your trading, which shouldn't really be complicated, because you probably see as well with a lot of beginners, which is also known as beginner's luck, because they come into trading, they'll make a little bit of money, even if it's on a demo account. They'll start to take quite a few wins in a row, and then when you start to research more into it, they'll start to lose and lose and lose until eventually they find their feet and refine things, data collect, etc., and then turn back to profitable. That's why the trader's journey is so typical. But it's again because they start to overcomplicate it and implement things that they've seen. I'm not saying for a new trader to just do random stuff on the market. You should go through that journey, because obviously when you're trading with conviction, you know how to trade, etc. Right, that's the story for a different video. But anyways, as you can see here, okay, we have our liquidity point. Again, you can also look at this as, okay, trend line. What people are going to be doing. A common way of trading is buying on a third touch of a trend line. Okay, you can also look at this as, okay, what people are going to be doing here. They're going to be selling on the trend line. So you can go ahead and draw it all up if you really wish to, but I don't do that. I just focus on 12 till 5 a.m. UK time, wait for sweep of either side, and trade when it feels or looks right based on the chart. Okay, Now again, sometimes price won't even sweep liquidity and I'll be in a trade. For example, it'll come, let's say, here, but price be creating higher highs and higher lows, and I'll simply be buying here and buying here even though the liquidity hasn't been swept. Because that's just, if I was waiting for liquidity to be swept 100% of the time, which again, I think is 100%, then I'd be too fixated on waiting for that sweep. So you take a step back, relax, don't overcomplicate it. Targets don't need to be big. You don't need to target to the moon. You don't need to target into daily lows or highs. Because again, we're trading off the 1 minute time frame. All you need is a 5 pip stop loss and a 10 pip TP. That's a 2-hour trade, in and out, within 5 to 20 minutes, if that. Okay, some trades will be held longer. But again, this is early in the morning. A lot of my trades happen from anywhere from 7:30 till 8:30. And within that hour, I've already made, or in the process of making, 2R and leaving a potential runner to the highs or lows. Sometimes it's more than the 2R, but that's just an example. You don't need to, a lot of people's problems with trading is that they don't necessarily, want to target a big risk towards just necessarily because they lack the capital. And obviously when you're targeting big risk towards on a smaller capital account, it means you're making more money on that account. Whereas if you just target 1 to 2, it's boring. But again, it still stacks up because a low risk reward comes with better psychology and a higher win rate. Whereas a bigger risk reward becomes worse on your psychology and a lower win rate. Significantly lower win rate. Therefore, you're more prone to a series of losses than you are targeting the smaller risk rewards. There's just something to keep in mind. Like I said, there's a lot of gems in this video that I've been discussing. So just write them down and take advantage of it. But this is a trade I'd taken. Like I said, the reason why my entry is there and not down here after the first initial engulfing is simply because that's where I've been filled in on the MasterTrader chart. But again, as you can see here, okay, price has simply took out the lows there and it started to shift bullish. Now I don't trade at these times again, but I do as we come onto this later session, pre-London. As you can see here, we had this first initial shifted upside, well, here, second shifted upside there, and then the third shift here. I managed to catch the third shift after the pullback. There's my entry. I just looked to target into the highs there after I took partials at a fixed 2R. Okay, very simple. Let's jump on to the next example. Now moving on to the next one here. Now this is just going without any higher time frame biases or any higher time frame markings, because obviously when you look at the higher time frame, even if you just zoom out here, you can clearly see that price is bearish. Therefore, looking to long in a bearish market or looking to short in a bullish market is similar to trying to catch a falling knife. But anyways, as you can see here, yes, price swept out that liquidity here, and also you can look at this as clear equal lows there and a potential support zone. There's going to be buyers within this area. Okay, and obviously again, price swept out that previous low and also the Asia low as well, and then we had seen the shifted upside here, which price took out the highs, but again, it still didn't clear the previous supply. And obviously when you look at this, you can look at this as a supply chain, as you have the previous mitigation there, which price previously reacted off here, but I'm not going to go ahead and jump into that just yet, or in this video. But as you can see here, price shifted bullish but tapped into supply. So even though it is still valid to take a long position from the area, it is just significantly lower probability. Okay, that's the key word. Still valid, just lower probability. Anyways, when we use the kind of confirmation that we use here at ZCFX, we're waiting for a pullback into this area of interest here. And when again use the kind of confirmation, price did not give us a clear entry signal. So that's also an example on why the kind of confirmation that we use is powerful. So if you haven't seen that video, make sure you go ahead and check that out or join the mentorship. But as you can see, anyways, price did not engulf. So even if you had taken longs with the engulfing, you couldn't have entered because there was no engulfing. And then price from there just traded short, indicating that there was just a bearish session from that point onwards. Now, would people be so fixated on the bullish bias because the Asia low? Yes, they would. But that's why it's so important to not be fixated and not try and predict what's going to happen, but more so react. That's another example of just going with the flow. Price clearly shifted back bearish here, but also mitigated a clear point of interest there and provided a nice short opportunity there. And also we took out the low there, new range low, new range high, price had mitigated this area there, and so on and so on and so on, all the way down here, providing plenty of short opportunities. But because you would have been so fixated on waiting for price to flip bullish, you would have missed out on those moves. So that's why, again, going back to the topic earlier that I discussed, don't overcomplicate it, just go with the flow. But what I'm going to do is probably going to wrap up the video here. But my main objective of this video was for you to understand what liquidity is, again in the simplest format: orders or entries and stop losses. Those two are the main two contributors to what liquidity is, or trading liquidity inside of the market. But like I said, you really don't need to complicate it or overcomplicate it. You just need to understand what it is and just trade what you see, not what you think. Okay. And that just goes back to the example here. Even though you think that price is going to flip bullish, just trade what you're seeing. You know, keep it simple. No need to overcomplicate it. But again, I'm going to end the video here because we're already like 20 minutes in. I don't want to keep it long. But that's what liquidity is. And also those are some trade examples and recaps that I've taken previously. This is just within the past week from the 6th of Feb, and it's currently the 10th of Feb. And those are two trades that I've taken. And unfortunately on this trading day here, I did not take any trades. Okay. And also, in terms of how to adopt it to your own system, it's very simple. You know, even if you don't want to trade my way in terms of the Asia run, that's fine. If you want to adopt it to your own system, just keep it in mind. For example, if you're looking to, let's say, you know, price is doing this, I'll change it to Y in a minute just so you can see. But let's say you're looking to short here. Even though it's valid, would it be better to short there because obviously again you've got liquidity, or would it be better to short after price has swept out that liquidity? So if you were to look at these two examples here, and I was to say to you, what is a high probability short to be taken? Is it here or is it here? It's still valid to take because again, liquidity shouldn't really influence your bias, and again you should just be trading what you see. Okay, because liquidity is a funny one. You don't know when it's going to be swept, similar to an imbalance or commonly known as a fair value gap. You don't know when it's going to be swept or partially tapped into or filled in fully for the imbalance. So you can only react once liquidity is being swept. But what I'm trying to suggest here is that, you know, it's better to be looking for shorts after this move rather than this move here. It's still valid to take, like I said, but maybe you want to, you know, this is where risk management comes into play, whether you want to reduce that risk, even though it isn't really recommended because you kind of want to stay consistent with the risk, but you can see where I'm coming from. So, you know, the reason why this is liquidity here is because it's equal highs. It's a resistance zone. People are going to be looking to sell from this area, so eventually it will be swept. Even if it's a short-term move for price to sweep, you can still look for those shorts there, and with the correct risk management, that can still be a profitable winning trade. So again, don't let pen and liquidity influence your bias, but use it as potential targets, if anything. But again, it's always better to trade after the liquidity sweep has occurred. Go and listen back to the video many times as you need, and make sure you write down as many notes as you need. But again, like I said, no matter how you trade, you can implement it to any system. You know, for example, let's just do a quick example here again. Okay. If you trade support and resistance, and you're looking to, let's say, you know, sell off this area because again, why? It's a clear resistance zone. It might be better to trade price pulling back into this previous support zone, which has now turned to resistance. So it'd in fact be better to take a short entry here rather than here, because you understand liquidity. That's just for those traders who are losing traders, who are getting stopped out when they're looking to enter the markets. If you just simply drag your entry to where your stop loss is, you'll probably be more profitable than what you currently are. but that's just support and resistance traders anyways. But like I said, if you want to learn a consistently profitable system, then I'd highly suggest you jump on a one-to-one call with me, or check out my overall mentorship and join the live calls, and obviously consume the video content. But with that being said, guys, like I said, it can be applied to any system, no matter how you trade. Just understand, but my objective in the video is for you to understand what liquidity exactly is, and that is what liquidity is. Thanks guys for watching, take care, and I'll catch you on the next one. Any questions, make sure you pop it below, and I'll be more than happy to help.